So we think that the capex story is holding up the overall growth story, and so we are not yet turning bearish on India.
So what are you working with as a number? If you're working with the old GDP series, then what would it be?
I prefer to look at old GDP series.
Sure.
And so we were at 4.5 at trough in F13.
Yes.
We are looking at 6.5 in March 16.
Okay.
So that's a meaningful, steady acceleration that we are building. And then March 17, we are at 7%.
Okay, no, that certainly looks good. And then if it is 7% in the old series, then perhaps we are at 8% in the new series. Let me come to what that means for earnings. Jonathan, we were expecting this turn in the earnings. I mean, 4.5% is FY13. I'm sure FY14 also by the old series is, closer to 5.5. But we have not seen the earnings cycle turn. In which quarter do you think we're going to see a meaningful jump in earnings growth?
I'd see in the next 2 to 3 quarters. In the most recent quarter, we're running at about 1% year on year. That's probably the trough. And if we get this growth pickup that Chetan was just talking about, we could be looking at high teens year on year earnings growth by this time next year. And I would say that that's a better outlook for earnings than we have almost anywhere else in emerging markets. Many of our underweight countries are trapped in quite deep or severe recessions, so places like Brazil or South Africa or indeed Russia, and actually with worse currency outlooks than India has too, so that should be borne in mind.
Okay, so you would say that India could give an earnings growth this year in FY16 of over 15%?
I think it's entirely possible, and actually if you look out to the March 2017 year end, my colleague Ridham Desai, who looks after India for us in detail here, he's about 15% above consensus. That has an effect on the forward multiple on the market. If you use consensus earnings, then India's trading about 1 year forward about 16 times. And that's actually now back in line with long-run averages. All of the kind of Modi premium in Indian equities versus the rest of emerging markets has now gone. Okay. We're back in valuation relative terms to where we were at the end of 2013. Okay. That's why we've been looking to upgrade India.
If indeed the Reserve Bank is able to achieve, a stable, if not 4%, at least a 5% inflation over the 2 years that we have been talking about, will that up the valuation matrix because it's going to be a stable inflation country?
Well, it depends what happens to valuations globally, clearly. But that multiple I just gave for India is a little bit below the multiple on the S&P and on Europe, and we think is more than fair for the return on equity that India delivers right now. And we at the peak, we're trading about 60% forward PE premium to emerging markets. That was late last year. That's now almost halved, particularly with the underperformance we saw January through March.
Okay. Well, Chetan spoke about several indicators, especially capital goods imports increasing and order books rising. So what would a sector-wise strategy be or a stock-wise strategy be?
I can't talk about stocks, but on the sector side, we certainly like consumer cyclicals and industrial cyclicals. And that's pretty well the opposite of our view on other large emerging markets, say like China, where growth is still decelerating. Where we're still very cautious is on sectors like materials. And indeed, when we look at where we've seen relatively poor earnings performance, telecoms has been a little bit disappointing in India.
Okay. I'll want to come back to China for a minute with you. But before that, since we have started talking sectors, the golden sectors, whenever Indian equities, whenever Indian economy doesn't perform well, have been the defensives, IT and pharma. You think their golden age is over for the moment?
Well, it depends a little bit on what happens to the rupee. So we're assuming that the rupee remains roughly where it is now, about 64 to the dollar going forward. But if you were to head to a more adverse global environment around a strong dollar and rising US rates, then those sectors do tend to come into their own, yes.
Okay, but okay, then let's finish that argument. When are you expecting the Fed rate hike? What might be the US bond yields at that time? And therefore, what may be the impact on India's at least 2 macros, yields and currency?
Well, on the currency, I gave the forecast already, and that's predicated on the idea that the current account remains roughly where it is, that we don't get a particularly, say, negative monsoon or a big spike in oil, which Chetan was talking about earlier. We don't think that's very likely. Okay. So we'd assume that the current account stays roughly where it is. And then in terms of the actual first Fed rate hike, that's likely to be in December, but the Fed will go quite slowly, in our view. And bond yields, 10-year yields, we think go back up to about 2.8, 2.6 to 2.8 by early next year. So, we've had a pretty sudden adjustment in bond yields. That's certainly why emerging markets have been performing so badly in the last 3 or 4 weeks. We wouldn't expect it to continue at this pace.
Okay. What's your sense, Chetan, if bond yields go to 2.8, 2.9 by early 2016, would not that impact Indian yields?
Well, it should, but I think you should not look at nominal. You should look at real yield. So to the extent to which inflation is then going to be below 5 as per our forecast, we think the real rate levels in India would be significantly high enough to ensure that the premium between India and US real interest rates are still reasonable enough not to be worried about this fact. And mind you, also the fact, as Jonathan mentioned, current account balance is important. If the current account balance is around 1.5 or below, that is equal to about our net FDI and some long-term flows that we get. It doesn't need to have, India doesn't need to have a big premium over US, but you can still safely assume to have some real premium over the US 10-year bond yield, and we should be still fine. Because at the time when Jonathan mentioned about the 10-year bond yield in the US to be at 2.6, 2.8, we are expecting inflation to be at about 2. So we're still talking about 0.6 or 0.8% real rates on the US 10-year. So that should not be too hard to swallow for India and cause any stress here.
You expect inflation to be at 2, that is WPI?
I'm talking about the US inflation. Sorry.
Oh, sorry. Okay. Jonathan, the other...
WPI we're expecting to be 1, actually.
Okay. Yeah. No, let me finish this other global arguments. You don't expect a commodity resurgence or the crude resurgence at all. What's the Morgan Stanley picture on crude, which is one big worry for India?
Well, I think when you look at the supply-demand balance, demand has actually picked up a little bit in the crude markets this year, but OPEC's keeping the market very well supplied, and that's basically their strategy, which is to slow down the development of the shale sector. That's why we think it's extremely unlikely that oil goes back to $100 a barrel. It's probably going to range trade roughly around where we are right now. And then for the other commodities, I guess the industrial metals and things like thermal coal, it's really all hinges on China's capex cycle and China's industrial cycle, which is still looking very weak to us. There are some bright points in the China economy, in the consumer and services sector, but the overall momentum in China's economy is really quite weak at the moment, continues to be quite weak.
Well, in that context, let me come to that China question. We saw this extraordinary performance of Chinese equity markets, and India was at that time, declining with every day. Was there an instance of Indian money going to China? How do you explain that, those 8 weeks from mid-April?
Yes, so I think you're meaning were foreign investors switching money from Indian equities
yes.
to China equities. There's not really that much evidence for that. I mean, the overweight of India did decline somewhat from about 800 basis points overweight to about 600. The long-run average overweight for India is about 400. But if there was switching, it probably was more towards Japan, in fact, which has moved to a more positive stance in global portfolios. Most foreign clients have not participated in this China rally, which has been mainly concentrated in the onshore A-share markets.
Okay. Nevertheless,